In 2017, the passage of the Tax Cuts and Jobs Act effectively doubled the standard deduction. This meant that a lot more people no longer needed to itemize. But for those who still itemize because of high levels of charitable giving or property taxes or other combinations of things like medical expense deductions, we still need to understand the moving parts of what can and cannot be itemized and put together a tax return that makes sense and doesn't leave the IRS with a tip, and that's what we'll be talking about today.
So Spencer, before we start talking about itemization, we really need to know what our baseline is for the standard deduction. So do you want to walk us through just a brief overview of the standard deduction, where it currently sits for 2023, and then what it looks like to itemize deductions instead?
Right, and the standard deduction overall is something that the IRS gives us to basically say, well, you're going to get some credit even if you don't itemize everything, even if you don't show us that you have this property tax and this level of charitable giving, so on and so forth. They've doubled it, so it's made it easier for a lot of folks to just not have that record keeping. Now, as we look at it, looking at 2023, it's $13,850 for a single filer, $27,700 for those who are married filing joint, and then $20,800 for a head of household. Now, the caveat here is that we've got an additional amount if you are age 65 or older that we need to add to that, or if you have other qualifications. So another $1,850 if you are a single filer who is at least age 65. If you are an age 65 or older and you're married, another $1,500 there. And then if you or your spouse are blind, then you have another amount that is added on top of that. It can double up there. So it can go quite a bit higher, but generally speaking, think about it. If you and your spouse are in your 70s, let's just say, you've got another $3,000 that you would be adding, so about $30,700 for a lot of our clients if they and a spouse are age 65 or older.
Okay, thanks for that baseline. That kind of helps as we think about these itemized deductions. So let's dive in. Mm-hmm. Someone decides, okay, I've had significant medical expenses. I've given significantly to charities. I have $10,000 in property taxes and state taxes. Mm-hmm. Okay, let's walk through some of these. Talk us through medical and dental expenses that you can claim on Schedule A.
Basically, medical and dental expenses have to be those that you're actually paying for. It can't be something that you're reimbursed for. So if Blue Cross Blue Shield is your provider and they say, well, you have $10,000 as a bill and we negotiated it down $5,000 and then we pay $2,000 and you pay $3,000, it's only that $3,000 that we start with there. So we've got to recognize that. We also don't have qualifying expenses if you have a cold and you go and you get Mucinex at the CVS. That is not a qualifying expense. Now, if you go and see a physician and they provide a prescription, then indeed that is a qualifying expense there. So there's a line of demarcation that we've got to be careful with as we tally these expenses. But the big picture is that most of us are not going to qualify for any level of itemization with our medical expenses because we've got to get above a threshold. Mm-hmm. We've got to get above at least 7.5% of our modified adjusted gross income. Mm-hmm. So if your modified adjusted gross income is $100,000, then you don't get any credit for any medical expenses in your household south of $7,500. Mm-hmm. Now, if you had medical expenses of $10,000, then you would have another $2,500 that you could add to this itemization piece here.
Right. So a lot of times this doesn't benefit a client, but what are some situations where it might actually benefit them?
Yeah, so if we think about one of the things that we see is really, really expensive dental bills because oftentimes we don't have a level of dental insurance that covers some of the bigger surgery or operations there. For a lot of our clients who are on Medicare, we don't see really, really high levels of cost in their prescription drugs or other kinds of treatments that they might have because Medicare picks up so much of it. Mm-hmm. So it's unusual that we'll see oftentimes the medical expense become part of that itemization just because you have that threshold that you've got to climb above.
Yeah. And I think the other one we talk with clients about is often long-term care.
Yeah.
And so as we're thinking about health savings account versus long-term care deductions, that's another one that it can really start climbing pretty quickly.
Right. And part of that too is you've got to work with the facility or the institution with respect to long-term care, because sometimes they'll issue bills and they will not be qualifying expenses. If the bill is more associated with just, say, providing food or some kind of custodial service that is not eligible for long-term care in this way, then it might not be, you might not be able to itemize it. There are other institutions that really focus on this, and they do a nice job of kind of bringing everything together and saying, well, this is the amount that you can itemize, or this is the amount that would qualify to be itemized, and then this is the amount that's not there. But it can be, to your point, a very high level. The thing that we always have to remember, though, is if you're getting reimbursed via insurance, long-term care insurance, well, we can't add that as an itemization.
Right. Okay. Anything else in terms of the healthcare side of things for itemizing?
I don't think so. The only other thing that comes to mind is there are certain types of procedures that do not count. So, if you want to go get a facelift, it's not going to help you there in terms of your itemization, because there are procedures that are considered elective procedures that will not be included there.
Okay. All right. Next, let's move over to one that really was also impacted by the Tax Cuts and Jobs Act. State and local tax deductions. Walk us through how these SALT deductions.
Well, first, I can already hear our New York and New Jersey and Connecticut clients sharpening their knives at the Tax Cuts and Jobs Act, because that $10,000 limitation was very punitive to some people and not other people. Now, I'm not going to debate the politics of why it was done or how it was done, those kinds of different things. But the reality is that we have a $10,000 limit of what can be claimed, itemized for your state and local taxes. Oftentimes, if we have clients that are in the Northeast or a higher tax state, maybe out west, there's going to be a lot more in tax for that state and local tax. But you would think about things like real estate tax. You would think about income tax for the state. You would think about other local taxes, that might apply. For people who reside in Tennessee and we don't have a state income tax, then you could look at sales tax and there would be an approximation, or you could do a whole tally of things, but typically it is more of an approximation based on your level of income that the federal government then will allow you to itemize.
And with this, one of the big things we have to keep coming back to is if you're going to itemize, you have to keep track of your receipts.
Right.
Just because you paid $5,000 of property tax, if you don't submit that receipt, as well as the rest of your itemized deductions, then the federal government might decide, hey, this might be a good candidate for an audit.
Right.
So really, when you submit your taxes, make sure that you add all of those receipts in, just so that you have the track and the record of this was the amount paid. For those sales tax options, the IRS does have a calculator on their website that we'll put in the show notes that you can take a look at and say, okay, what is kind of that threshold of what the IRS would suggest as sales tax deduction?
And this can be really onerous, especially on the medical deduction side of things. I mean, if you track every bill that you get from a physician, every prescription drug, even those that are generics, I mean, you're going to have a lot of different documentation that's going to be required. But that's what the IRS expects of you if you're going to itemize in that particular area. Now, you might have $10,000 of state and local tax, and you might be writing big checks to charity, and you might have some medical expenses that you can't itemize. Well, you don't need to have the receipts for those medical expenses if you're not going to choose to itemize on that. But everything that you write down on that report that is going to garner you a lower tax bill, garner you help, then you need to have that documented.
All right, so let's talk about this next one, interest expense. What, in terms of interest expense, can we itemize?
Well, we used to be able to itemize a lot more, but if we look at it now, it is just interest expense that is up to $750,000 of mortgage or HELOC expense related to our homes. Now, if you purchased a home and it was a number of years ago, let's say you purchased a home in the 1990s and it was for $1 million, then you do have a higher threshold. So it's $1 million, if it's not been in the last couple of years. There is a provision that if you purchased it, I think before 1987, that there's no ceiling. Of course, I don't know any people that are still paying a mortgage from before 1987. That has been grandfathered in. So we have to recognize for most homes that have been purchased here recently, it's a $750,000 threshold of the value, paying the interest based on that. And then we also need to recognize that there are some other pieces to that. So if we're paying points, then that can be itemized. If we're paying for other expenses, sometimes those can be itemized there as well with respect to that putting in place that overall mortgage.
Okay. So Spencer, as we think about the different homes that we could have, we've got primary, second home, renting out a second home. What kind of things, which mortgages can we deduct interest expense on? And then secondarily, what documents do we need to submit to the IRS?
So we can obviously deduct interest from our primary home, but also a secondary home if you stay there at least 14 days a year. Now, typically what would happen is if you buy a rental home and you're renting it out the entire year, then that interest expense you would be running through a different schedule there. It wouldn't be Schedule A. It would be schedule that would compile, I believe it's Schedule E, that would compile all of the different elements of renting that home out, the income, the expense, and part of that expense then would be the mortgage or the interest expense there.
Mm-hmm. Okay. And then in terms of documentation required, what do we need to submit to the IRS here?
So generally speaking, it's the 1098, and it would be for the mortgage or the HELOC there. If you have a closing disclosure, you also want to pass that on typically to your tax preparer because there's some moving parts that they want to be able to document and help make sure that everything gets straight for the long term there.
Okay. So next, let's talk about charitable contributions. What does it look like? How do we deduct those for Schedule A?
Well, first we want to have, again, the documentation of everything there. We need to know what we've given. There are different types of gifts. So there are financial gifts that would be cash, and those tend to be the easiest oftentimes to track. But there's also gifts of, say, appreciated securities that could be publicly traded securities. And whether that goes to a donor advised fund first or whether that goes direct to the end institution, that's also deductible. There's a particular way, that's deductible. And typically for publicly traded securities, it is the average of the start and the closing price on that particular day when the contribution of the security is made. So there's some moving parts there. There are also other types of gifts that could be tangible assets. It could be a car or a boat or other types of value gifts. And if you make those, then typically you need a qualified appraisal if the amount is above a certain amount.
Yeah. Okay, so let's talk about, there's deduction limits of these. So when we think about giving cash to those organizations, if you give cash, you can give up to 60% of your adjusted gross income. For securities, if you're giving appreciated securities, it's typically 30% of your adjusted gross income. So we just want to be aware that there are these limits. You don't want to go above those thresholds. You can do a carry forward. So if you give more than that 60% or more than that 30%, then it will carry forward to future years. But we want to try to maximize within that range. What are some other things that we need to know? Specifically, I think there's eligible institutions, and then there's institutions that are only eligible for a lower threshold. So private foundations have different thresholds. So just things that we need to know when you make those gifts. This is really a place where you would want to talk with a financial advisor, a tax professional to make sure, hey, are we crossing these thresholds? Are we giving too much? Should we do this over a period of years? Anything else we need to think about when we think about giving to charity?
Well, I think you're spot on. If we are making gifts that say are north of about 25% of our modified adjusted gross income, in particular if they're complex gifts where there's securities involved or illiquid assets, then we really want to hone in and talk with a tax professional, a financial advisor in those situations. As you mentioned, there are gifting limitations as well that are for higher amounts. So if we make gifts that are in cash, up to 60% of our modified adjusted gross income, we want to be careful there because if we gave just above and beyond that and it's carried forward, why the next year, though, we might have to apply it, but we might have a standard deduction that year and get no credit for it.
Yeah.
So getting credit from a tax planning standpoint is not the only reason that we give to charities. Obviously, it is a small reason that we'd like to reduce our tax bill there to the extent that we can under law. I think the other thing that we want to make sure that we come back to is these have to be gifts to institutions that are actually charitable institutions. If I had $1 for every time someone asks me if they give to a child or a grandchild or a nephew or a niece, if that is a charitable gift, well, it's not. I'd be a rich man. It's not recognized by the IRS. Now, it's wonderful to be giving to other people, living and giving, as we say, and it can have a huge impact, and sometimes far more than giving to charitable institutions. However, the IRS does not recognize that that is something that they will knock your tax bill down for. The reality is, though, that there's some pitfalls that we need to avoid if we're doing charitable gifts and we're expecting those to get recognized by the IRS. Can you unpack a few of those?
Yeah, so I think some of the big ones are gifts with strings attached or quid pro quo agreements. So if you are a tax professional and you say, I will give my time to a charitable institution as a volunteer, you can't then deduct that on your Schedule A. That is a gift. It's a gift of your time, but it has a string attached. If that gift has a string attached, if it is in trade for something else, then you have added value and you can't deduct that. The other thing is overstating property value. If you have a piece of property that its fair assessment is $500,000, but you try to maybe overstate that, say, oh, it's worth $600,000, and I gave it at $600,000, then that's not something you can do. Lack of records, like we've talked about. You need to send the documentation. Just like we were talking about with that property value, you're probably going to need an appraisal if you give real property, whether it's a home or a piece of land or boat, car, jewelry, any of those things. You can't just write down, my home is worth this and give it.
Right.
So make sure that you're not overstating that. And again, contributing to individuals. This is one, again, we come back to, you can't get a tax write-off for giving to your kids. And really, you need to make sure that you're not crossing the threshold where you've increased the gift above $18,000 for 2024, because then you need to actually tell the IRS that you gave to an individual above that $18,000 limit. So just some things to be aware of. The IRS just tracks that. You're going to have to fill out a gift tax form. But with a state tax threshold so high right now, it's unlikely that if you give a gift of $18,000, it will really penalize you at all. But just some things to be aware of there.
And one of those areas even that the IRS has been cracking down on are the contributions that people make to universities and get athletic tickets from. Because there has to be this demarcation between what is the gift to the university that is independent of getting any kind of seat, to a basketball or football game or whatever it might be. So IRS is really taking a much closer look at these kinds of things because they don't want that quid pro quo relationship to be knocking down somebody's taxes where they give $10,000, but hey, they got the luxury box seats for, the big game. So there wasn't really that much that the university was getting in return.
Right. Well, let's talk about the big game. Yeah. I decided that I wanted to download a sports betting app, and I had lost a whole lot of money on sports gambling. I didn't actually do that. But if I did, can I deduct that?
So you can only deduct that up to the point that you actually had winnings on the other side of it. So if you had winnings of $100,000 and then you went and you lost all of it gambling in a different way, then you could deduct that. But you can only do it up to the point that you actually have the winnings.
Okay. Don't gamble. Please don't gamble. It's not a wise decision. We know that some people think it's fun. It's not a wise financial decision. Yeah. So please don't try to itemize those deductions just because it's toxic. Gambling is toxic. It can really erode wealth very quickly. But we did want to cover that one.
Yeah.
Well, thanks for sticking with us through these Schedule A deductions. If you have any questions about itemizing, how to clump and bunch, or donor advised funds, or things that you can utilize to maybe consider taking an itemized deduction one year, we would love to have a conversation with you for our clients. Otherwise, we look forward to talking with you again soon. If you like these financial planning videos, please share it with a friend. And if you have questions, Go to our website at SeriousRetirement.com. This content was provided by Retirement Planning Services. We are located in Knoxville, Tennessee. You can visit our website at SeriousRetirement.com. The information in this recording is intended for general educational and informational purposes only and should not be construed as investment advisory, financial planning, legal, tax, or other professional advice based on your specific situation. Please consult with your professional advisor before taking any action based on its contents. Advisory services offered through Retirement Planning Services, LLC.